What's going on YouTube? Listen up, young elder gang. This is Shalonda Williams, one of Big Mama's daughters, the lawyer and real estate agent at You with Another Banger. Please make sure you like, subscribe, and share this video, fam. I hope this video get at least 100,000 likes. In the following video, you will find history, definitions, scripture information, and best of all, what we Americans have been deprived of from the beginning, the truth. Keep in mind, this content used in this video is intended for educational and informational purposes only. We will give you the total truth as we best understand it today. Be sure to hit that like button, young elder gang. Hit that subscribe button if you're new to the channel. Hit that bell and don't forget to check back with us every day for new content. All right, let's get started. $1 million worth of game here. Now before we go in, let me break down a few terms for you. Real estate is land and any permanent structures or improvements attached to it, such as buildings, roads, and utility systems. It can also include natural resources like water, minerals, plants, and animals. Real estate is a type of real property, which is different from personal property, such as vehicles, furniture, and jewelry. Real estate is considered a valuable asset that typically appreciates over time. The value of real estate can be an indicator of the health of an economy. Real estate can be used for residential, commercial, or industrial purposes. Residential. Property intended for human habitation, such as single-family homes or multifamily rentals. Commercial. Property used for business purposes, such as office buildings, malls, restaurants, and hospitals. Industrial. Property used for manufacturing, warehousing, production, and assembly. Real estate can be owned by individuals, business corporations, nonprofit corporations, fiduciaries, or any legal entity. Equity in real estate is the difference between the current value of a property and the amount of money owed on a mortgage minus any other liabilities. Equity can increase or decrease over time, and it can be used to secure loans or lines of credit. Equity increases when the value of the property increases or when the mortgage balance decreases through payments. For example, if a home is worth $300,000 and the mortgage balance is $150,000, the equity is $150,000. Equity decreases when the value of the property decreases faster than the mortgage balance is paid down. Using equity, homeowners can borrow against their equity through a home equity loan or line of credit. This can be used to pay off high-cost debt or college tuition. Equity can also be obtained through the amount of the down payment made when purchasing a property. Making smart improvements to a home can also increase its value and equity. An investor is a person or entity that puts money into a business or organization with the expectation of financial gain. Investors use financial instruments to earn a return on their investment and achieve financial goals like saving for retirement, funding college, or building wealth. Investors may use strategic planning and market analysis to invest in areas that can generate wealth. They may also own assets that don't produce anything for them but instead rely on selling the asset to someone else for a profit. These assets are considered more speculative and can include cryptocurrency, art, collectibles, and commodities. There are different types of investors, including institutional investors. These large players in the market include pension funds, mutual funds, money managers, insurance companies, investment banks, and more. They can invest on behalf of others or for themselves. Business investors. These investors can be wealthy individuals, large firms, or equity firms. They invest in a business in exchange for a share of the company, profits, or loan repayment. Accredited investors. These investors are considered sophisticated and have enough experience or wealth to make certain risky investments. In the United States, an accredited investor must have a net worth of over $1 million. You need capital. Capital in business is money used to fund a company's operations, growth, and investments. It can also refer to a business's net worth or book value. Businesses need to manage their capital efficiently to meet their obligations, innovate, and expand into new markets. To determine how much capital a business needs, you can add up all of its startup expenses and current investments, then subtract the projected cash flow from operations. A company's working capital is the money it has available to cover upcoming expenses. Working capital is calculated by dividing a company's current assets by its current liabilities. Private equity real estate funds allow high net worth individuals and institutions like endowments and pension funds to invest in equity and debt holdings in property assets. Using an active management strategy, private equity real estate takes a diversified approach to property ownership. Private equity real estate, REPE, is a type of real estate investment where outside investors pool their money to acquire, develop, and improve properties. How does it work? REPE firms raise capital from investors called limited partners, LPs, and use it to acquire properties. They then improve the properties, such as by renovating or enhancing their strategies, and sell them for a profit. Who invests? LPs can include pension funds, endowments, insurance firms, family offices, and high net worth individuals. What do they invest in? REPE firms typically focus on commercial real estate, such as offices, industrial, retail, and multifamily properties. They may also invest in specialized properties like hotels. What are the benefits? REPE can be tax efficient, with returns taxed at the long-term capital gains rate unless the fund sells an asset within a year. It can also provide high potential returns, with annual returns in the 6% to 8% range for core strategies. What are the risks? REPE is risky, and investors can lose their entire investment if a fund underperforms. It's also illiquid, meaning that performance is highly dependent on management skill and quality. REPE funds became popular in the 1990s as a way to acquire properties when values were falling. General partners invest in a variety of property types in different locations. Ownership strategies can range from new development and raw land holdings to complete redevelopment of existing properties or cash flow injections into struggling properties. A general partner is a member of a business entity called a general partnership and has the following responsibilities. Liability. General partners are personally liable for all the partnership's debts and obligations. This means they are also liable for the actions of other general partners, even if those actions were wrongful. Management. General partners actively manage the business and have the power to legally bind it. Fiduciary duty. General partners have a legal obligation to act in the best interests of the partnership. Breaching this duty can result in personal liability for the general partner. General partnerships. Definition, features, and example. A general partnership is a business entity formed by two or more people who contribute money, property, labor, or skills to the business. Each partner shares in the profits and losses of the business. General partnerships are often the business entity of choice for people who want to work together. Both general and limited partnerships are pass-through entities for tax purposes, meaning that owners report the business income on their personal tax returns. An ownership strategy refers to a deliberate plan developed by business owners to guide the future direction of their company, outlining how ownership will be structured, managed, and transitioned over time, particularly considering factors like family dynamics, succession planning, and long-term goals for the business, aligning the owner's values and objectives with the company's vision. Key points about ownership strategies. Focus on long-term vision. Unlike a typical business strategy, which is often more short-term focused, an ownership strategy considers the company's future generations and how ownership will be managed across different stages of the business life cycle. Family business relevance. This concept is particularly important for family businesses, where deciding how to distribute ownership among family members and manage potential conflicts is crucial. Key considerations. When developing an ownership strategy, owners need to consider aspects like purpose of ownership. Why do the owners want to own the business? Risk tolerance. How much risk are the owners willing to take? Liquidity needs. How much flexibility do owners need to access their investment in the company? Control expectations. How much control do owners want to maintain over the business? Succession planning. How will ownership be transferred to the next generation or other suitable parties? Example elements of an ownership strategy. Shareholder structure. Defining how shares are allocated among owners and potential future owners. Governance structure. Establishing clear rules and processes for decision-making within the ownership group. Dividend policy. Determining how profits will be distributed to owners. Buy-sell agreement. A legal contract outlining how ownership interests can be bought or sold under specific circumstances. Here is a look at how investors can participate in private equity real estate and an overview of the industry's opportunities, risks, and restrictions. The key takeaways are private equity real estate funds allow accredited investors to pool assets and invest in real estate properties. Accredited investors include high net worth individuals and institutions, with investment minimums usually around $250,000. Investors are limited partners in these funds, while fund managers make all investment decisions. These real estate funds charge fees, such as management and performance fees, which reduce investor return. Finding the ideal private equity real estate fund. First, the average person is incapable of taking part in private equity real estate investments. The traditional private equity fund requires investors to inject a minimum of $250,000 into a fund, although most managers are seeking individuals or institutions that are willing to provide upwards of $20 million to $25 million into a long-term collective investment scheme with other investors. Real estate funds charge a variety of fees, including fund upfront fee, a one-time fee that covers costs like legal, marketing, and capital raising. This fee can range from 1.53%. Fund management fee, an annual fee that typically ranges from 0.52%. This fee is usually charged on committed or invested capital. Fund administrative fee, an annual fee that is usually less than 0.5% per year. Asset management fee, a yearly fee that ranges from 1-2% of the total equity invested. This fee is paid to the deal sponsor for managing the assets as a whole. Incentive fee, also known as carried interest or promote, this fee is an allocation of the fund's profits. The amount of the incentive fee can vary widely. Acquisition fee, a one-time payment that is a percentage of the purchase price of a building. This fee rewards the sponsor for their efforts in finding and acquiring the property. The fee can range from 1-3% of the purchase price. Disposition fee, a fee that rewards the syndicator for marketing and selling the property. Since there is little regulation over private equity real estate funds, opportunities are traditionally limited to accredited investors. This means that the investor must have personal or joint assets of at least $1 million, not including the value of their primary residence, or the individual's yearly income must have been at least $200,000 in the past 2 years, with a similar amount expected in the current year. Couples who have a combined income of at least $300,000 over the previous 2 years and have a reasonable expectation that their income levels will remain at this level in the current year are also eligible. An accredited investor is an individual or business that can trade securities that are not registered with the Securities and Exchange Commission, SEC, participate in investment opportunities that are not available to the general public, be exempt from certain SEC regulations. The SEC uses the term accredited investor to describe investors who are financially sophisticated and have a reduced need for regulatory disclosure filings. To become accredited, an individual or business must meet at least one of the following requirements: income, net worth, asset size, governance status, and professional experience. For example, an individual is considered accredited if they earned $200,000 or more in income over the past 2 years, have a combined income of $300,000 or more with their spouse, have a net worth of $1 million or more minus the value of their primary residence. Accredited investors can invest in a wide range of opportunities, including private equity, hedge funds, and venture capital. Accredited investor, duties, and requirements. These opportunities can offer the potential for high returns and increased diversification. A reasonable expectation refers to what someone has good grounds to believe will happen or ought to happen, based on the circumstances and considering what a typical person would expect in a similar situation. It essentially means a belief that is not unrealistic or excessive, and is considered fair to hold based on available information. Individuals or couples seeking to invest in private equity real estate should locate a firm that specializes in the discipline. Upon examining a private equity firm's options of funds, they should understand the nature of each private equity fund structure, which is typically a limited partnership. A limited partnership, LP, is a business entity that consists of at least one general partner and one limited partner, and is a type of partnership with limited legal liability. General partners have unlimited liability for the business's debts and are responsible for managing the business. Limited partners only risk their capital contributions to the business and are usually not involved in the day-to-day operations. LPs are often used to raise capital, as they allow investors to participate in a business without taking on the day-to-day management or risking more than their initial investment. Limited partners are sometimes called silent partners. LPs can be used for a variety of purposes, including energy companies form LPs to own pipelines and other midstream assets. Some of these LPs are publicly traded on stock exchanges and are called Master Limited Partnerships, MLPs. Real estate operators form LPs to invest in real estate, such as a portfolio of properties or a single property. When joining a fund, outside investors will become limited partners, meaning they accept liability for the money they invest in the fund and have no veto control over the properties selected by the general partners, GPs. A limited partner's money will be pooled with other participating investors, and fund managers will build a portfolio of properties aimed at maximizing profitability and minimizing financial risk. A limited liability company, LLC, is a business structure that protects owners from personal liability for the company's debts and obligations. Separate legal existence. An LLC is a company with its own legal existence, separate from its owners. Limited liability. Owners are not typically personally responsible for the LLC's debts and obligations. Pass-through taxation. Business income is passed through to the owners, who report it on their personal tax returns. LLCs have several characteristics, including flexibility. LLCs allow for many forms of organization and tax treatment. Membership. Most states do not restrict ownership, so members can include individuals, corporations, other LLCs, and foreign entities. Single-member LLCs. Most states permit LLCs with only one owner. Exceptions. Some types of businesses, such as banks and insurance companies, generally cannot be LLCs. You should check your state's requirements and the federal tax regulations for more information. You can also consult a business lawyer for advice and guidance. LLCs and corporations, or Incs., differ in several ways, including ownership. In an LLC, the owners are called members, and they own the business's assets. In a corporation, the owners are called shareholders, and they own stock shares in the corporation. Management. LLCs have a more flexible management structure, allowing members to manage the business themselves or appoint managers. Corporations have a more rigid structure, with shareholders electing a board of directors. Taxation. LLCs benefit from pass-through taxation, where business income passes directly to owners' personal tax returns. Corporations are subject to corporate income tax, and shareholders are taxed again on dividends. Formation. LLCs are formed when members file a charter and prepare an operating agreement. Corporations are formed when shareholders file articles of incorporation and select a board of directors. Governance. Corporations have more rigorous governance and compliance standards, including more paperwork, meetings, and record-keeping requirements. Raising capital. Corporations can raise capital more easily by issuing stock. Liability protection. Both LLCs and corporations provide limited liability protection. When deciding between an LLC and a corporation, you can consider growth plans. Your plans for growth and funding. A limited liability company, LLC, and a limited partnership, LP, differ in several ways, including management. In an LLC, members can choose to manage the business themselves or elect a manager. In an LP, a general partner manages the business, while limited partners are passive investors. Liability. LLC members are protected from personal liability for business debts and claims. In an LP, general partners are personally liable for business debts, but limited partners are only liable if they take an active role in managing the company. Taxation. LLCs can be taxed as a corporation or a pass-through entity, while LPs are usually taxed as a pass-through entity at both the federal and state levels. Structure. LLCs can have any number of owners, while LPs are made up of general partners and limited partners. Documents. LLCs have an operating agreement, while LPs have a limited partnership agreement, LPA. Registration. LLCs and LPs have different registration procedures, which vary by state. The choice between an LLC and an LP depends on the desired balance of control, liability, and investment in the business. A financial advisor can help you choose a business structure. Understanding the fund's costs and investment structure. Private equity real estate funds have a number of management and performance fees that must be paid by investors. It's common that private equity funds require an annual fee of 2% of capital invested to pay for firm salaries, deal sourcing and legal services, data and research costs, marketing, and additional fixed and variable costs. However, there are no limits to these investor fees. An investment structure is the legal entity that determines how investments are owned. The structure of an investment can vary depending on the type of investment, the investor, and the business. Individual investors. Investors can purchase assets in their own name. Partnerships. Investors can own assets in a partnership. Companies. Investors can own assets in a company. Trusts. Investors can own assets in a trust. Mutual funds. Investors pool money to purchase shares in a fund, which is then invested by a professional. Index funds. Investors invest in an index, such as a stock index, and the fund's returns are based on the index's returns. Structured investments. These are usually fixed-term debt obligations or certificates of deposit. The potential return or loss is determined by the performance of underlying assets. Equity investment. Investors purchase a piece of ownership in a business. Convertible debt, a hybrid of debt and equity investment where the loan can be repaid or turned into an ownership share. Majority investments. A new investor purchases a high enough percentage of shares to own a majority of the company. Private equity funds. A private equity firm, general partner or GP, collects money from investors, limited partners or LPs, to acquire controlling portions of private companies. Individuals should have a good grasp of these costs before investing because that will limit the total return on investment. For example, if a private equity real estate fund raised $500 million, it would collect $10 million each year to pay associated expenses. Throughout its 10-year cycle, a fund would collect $100 million in fees, meaning that only $400 million would actually be invested during that decade. Private equity managers also receive a carry, which is a performance fee that's traditionally 20% of excess gross profits for the fund. Investors are traditionally willing to pay these fees due to the ability of the fund to help mitigate corporate governance and management issues that might negatively affect a public company. Most private equity real estate funds are considered need-based investments, meaning that partners commit capital to general partners in installments on an as-needed basis. As GPs locate potential investment properties, the fund will send a formal request for capital that limited partners pledge to the real estate fund at the beginning of the cycle. Known as a capital call, it's a legal obligation that the limited partners must fulfill. Should a limited partner fail to meet a capital call, a fund may force that person or institution into default and forfeit their entire ownership share. Other limited partners typically receive the opportunity to purchase any forfeited shares in the event of such a default. Investing in private equity firms comes with high risk, illiquidity, and high fees. Types of private equity real estate strategies. A need-based investment refers to an investment strategy where the focus is on allocating funds specifically to fulfill essential financial needs, prioritizing necessary expenses like housing, food, healthcare, and retirement savings before considering discretionary spending or higher-risk investments, essentially aligning investments with one's current financial priorities and gaps, rather than solely pursuing potential high returns. When investing in private equity real estate, there are traditionally 4 types of investment strategies. Core is the most conservative strategy and might only include properties offering lower risk and lower potential returns because they exist in well-populated or well-traveled locations. This strategy might also focus heavily on investment in high-quality, high-value properties that require very little redevelopment or maintenance. These properties offer predictable cash flows and are commonly comprised of fully leased, multi-tenant structures. Core Plus requires a bit more risk but can offer a higher return than the core strategy. These properties require modest levels of value-added activity or enhancement to the location. Value-added is a medium to high-return, moderate-risk strategy that centers more on property development and market timing. In this strategy, portfolio managers purchase properties, engage in some level of redevelopment, and sell when the market is performing. Value-added properties typically require changes to management, physical improvement, or the addressing of capital constraints. These steps include building renovations and seeking ways to increase rental rates in improving markets. Value-added strategies also include the turnaround of failing operating companies or assuming debt for control of underlying properties. Opportunistic provides the highest level of return but assumes the most risk. With this strategy, managers purchase properties that include undeveloped land or in markets that are underperforming or lightly trafficked, accepting risks and long-term outlook. Investors in private equity real estate should understand that by investing in a fund, they must be willing to accept that their capital may be tied up for a predetermined period that could last many years. In addition, multiple risks exist in the real estate market, and a large amount of investment could be required during capital calls at a time when an individual has low cash flow. Many GPs structure their funds as decade-long investments or longer, and they provide little or no opportunities for investors to withdraw or redeem their money. The illiquid nature of private equity funds requires investors to understand the risks of keeping their money tied up for an extended period. The nature of private equity fund structures makes it very difficult to evaluate a fund's financial performance or the properties it holds. Since limited regulation of private equity real estate funds exists, general partners aren't required to offer any updates to investors on potential investments, valuations of the portfolio, or any other additional information related to the investments. Investing in private equity real estate requires limited partners to commit significant capital and fully trust that the fund manager will meet their investment goals without having any required level of transparency. Fund managers, however, do typically send updates to their investors and may choose to be transparent about performance in order to instill confidence in any current or future fund. Key point here are: what is private equity? Private equity firms invest in companies that are not publicly traded, with the goal of increasing the company's value by making improvements and then selling it at a higher value for profit. Private equity firms raise money from investors, make acquisitions, improve the company they bought, and either sell it or take it public. What is an accredited investor? An accredited investor, as defined by the Securities and Exchange Commission, SEC, is an individual with a net worth over $1 million, not including their primary residence, with or without a spouse or partner. An individual with an annual income over $200,000, $300, 00 if with a spouse or partner, in each of the 2 previous years, with an expectation of the same for the current year. Accredited investors are assumed to have enough financial wealth to bear the higher risks that come with alternative investments, such as hedge funds and private equity firms. What does private equity real estate do? Private equity real estate entails private equity companies investing in real estate companies, such as condominiums, hotels, office buildings, residential properties, and more. Private equity firms raise money through investors, acquire properties, and then improve the property's operations, enhance their strategies, and make renovations, among other changes, all to increase the value of the properties to sell them for a profit. The bottom line: prior to investing in private equity real estate, individuals must determine if they're qualified to take part in the process. Those who are qualified will want to explore their personal investment objectives, liquidity requirements, and tolerance for risk in the real estate markets. After speaking with a financial advisor, investors should study a variety of different funds to obtain a better understanding of the management strategies of the general partners and the past performances of other property funds. Invest in real estate with the Fundraise Flagship Fund. Looking for a way to add real estate to your portfolio? Discover the potential of the Fundraise Flagship Fund, a robust $1.3 billion real estate portfolio ranked among the largest 25 global interval funds. Access the fund's unique build-for-rent strategy and more. Before investing, consider the fund's objectives, risks, charges, and expenses. Prospectus available at fundrise.com/flagship.